In America, half of every dollar spent on brand medicines goes to entities who don't make them. While middlemen like PBMs and 340B hospitals drive up costs, Biopharma is investing $500 billion in new infrastructure and manufacturing here at home, and helping patients buy medicines directly at lower prices. Tell Washington to end middlemen markups and put American patients first. Visit phrma.org/middlemen.
Reality radio for a really great future. We're talking real money.
You know, it's funny. Sometimes investing does feel a little like the Wild West. There's just very little regulation. A lot of people doing whatever they want. You are kind of left to your own devices. You know, the phrase caveat emptor definitely applies. You need to take care of yourself. You need the 6-shooter on your hip, not a literal one, a figurative one, to protect yourselves against people who are going to take advantage of you. And much of the industry can be a very confusing place. It really can. Welcome to Talking Real Money. I'm Don McDonald, along with Tom Cock, and this is the place where we try to make money make sense. And today, we're going to take a closer look at one of our favorite brokerage firms, Charles Schwab. And Tom has written a little screenplay about Schwab called Charles Schwab, The Good, the Bad, and the Ugly.
Can you do the... There you go. Yeah, it's okay. And you call them a brokerage. I prefer to call them a custodian because I think
but
that's
they're
what
a broker.
Do.
No,
I know.
they're
No. I know.
They're
I'm not disagreeing. But to me, to our clients.
To us in our company, they don't really... Well, they do act as a broker, though, because they make the trades.
That's true. But
they hold the securities.
They hold the securities. And I think as a custodian for registered investment advisors like us, they're the best. I've worked with others. We've worked with Fidelity before. We worked with some others. I think Schwab's the best. They built out this... correct.
Ameritrade, I think. Yeah.
Well, they bought them. But, I mean, they built out this part of the business better than, I think, than anybody else. But that's my opinion. So, and yes, I know to many, as you said, brokerage, because where do they come from? Well, they come from... What did it cost you to buy and sell a stock back in the day before Schwab started offering a discount? I mean, it was like $50. It was some ridiculous number, right?
It was somewhere between 2 and 20%, depending on the size of the trade.
Crazy. And Schwab came along and they were the first, I think, right, to be
they were
kind
doing
of a discount
discounts.
broker. Yeah, discount. And
right. So for like, I think it was originally like $40 or $50 for a trade. When I was with Dean Witter, we were charging $100, $200 for a trade or more. And they said flat rate trades. And then they went to free trades. Free on almost everything.
Yeah, which is great. But here's the thing. So it puts them in this position of being a leader to others in the business. And the fact, as I said, they are the place that our clients hold their money. So when they speak, you listen. That was Merrill Lynch or something, right? Anyway.
Yeah, but not anymore. The people aren't listening to Merrill. They're listening to Schwab.
They're listening to Schwab. So when Schwab CEO Rick Wurster warns of a conflation between gambling and investing in a keynote to many advisors like us, people pay attention. He took aim at the blending of sports betting and prediction markets within financial services. And you know who we're talking about, and you know who he was talking about, Robinhood. And Interactive Brokers offer prediction market for users to place wagers on the outcome of events like sports and politics and prop bets, which have been in the news lately when a couple of pitchers both got charged of the federal crime for throwing. They didn't throw the game, they threw a pitch. They literally threw the pitch. Can I say anyway?
Because you can bet on the pitch they're going to throw.
Don't get me going. You can make prop bets on college basketball games. I mean, this is ridiculous. But Americans, according to this piece...
I've got a bet on the Washington State soccer girls soccer championship.
Will
coming up.
Aria get a goal or not?
Yeah.
I'm not going to say anything. I don't want to get in trouble. So Americans, according to this piece in Investment News, legally bet $150 billion on sports last year. 40 states now
legally. I'm glad you qualified.
Legally. I know, legally. 40 states now offer legal sports betting. And he correctly points out, thank you, CEO Wurster. He says only 5% of the people that go on sports gambling apps pull out more money than they put into the app. It's the opposite of the benefits of being a long-term investor. Yeah, it's a complete opposite. There's no comparison. So I was very glad to read that he made this statement. I know it's a poke at his Robinhood, which some people think are going to, be the place of choice for investors in years to come. So that truly is good, right? Isn't it? I mean, it's good that he spoke out. It's good that he said that. It's good that they hopefully believe that, and they will not offer that as part of their services.
He had the courage to step out onto the street and face down the bad
That's
guys.
the good. The bad is the experience that I heard about 2 weeks ago. Somebody called, said, I thought you guys work with Schwab. I said, yeah, we do. Now, remember, we work with the institutional side of Schwab.
Not the retail.
Not the retail. He walked into the retail, and they tried to sell him a bunch of stuff. And they said, I thought they were full-time 100% fiduciaries. I said, nope. All their folks are not.
No, they're not.
They're not. We are. But that's the confusion, right? Well, you guys work. No, well, we work with Schwab, but that's where we hold our clients' money. And that's bad. I think, again, Schwab, if they want to set themselves apart, they would move to a model where all the advisors in their office are only fiduciaries, but they're going to leave money on the table. That's the problem.
Lots of money on the table.
And Fidelity has the same thing, because we know people that work at one of the local Fidelity branches, and they're not all fiduciaries, and they sell annuities and all kinds of stuff that we don't recommend. Because what did you just say about the Wild West? I would say it's a profit deal, right?
Yeah,
I mean, they're going to make the money. Yeah. So that's the bad. But here's the part that got my attention recently that really is the ugly. Really is the ugly, where Schwab's simply saying, we got to make money like everyone else. They went out, Charles Schwab I'm speaking of, and bought Forge Global, a firm I'm sure you're very well aware of.
Never heard of Forge Global.
It's one of the major platforms that allows investors to buy shares in promising private companies.
Oh, okay.
It's a marketplace where investors can buy stake in late-stage startups like crypto exchange Kraken, artificial intelligence leader OpenAI, and here's the part that I absolutely hate. The minimum investment, you don't have to be an accredited investor. You basically have very little money, $5,000. You can make a wager on one of these private companies.
And that's really what it is. It's wagering. It's wagering with substance.
It's better than sports betting.
It's wagering with a potential asset.
Yeah. Investors.
There is no asset in sports betting.
No, there's none.
None.
Total. Investors have bought and sold more than $17 billion in private company shares on Forge's platform, according to Schwab. The brokerage will offer Forge's private shares to ultra high net worth clients once the deal closes, and then plans to expand access. More than a dozen other platforms selling shares in private companies have opened. In other words, they're going along with the crowd here. They see a buck to be made. They bought up this firm. They're going to make this available because they want to make sure you get to take advantage of the gold rush that is privately held companies.
So there you have the good, the bad, and that last one, the Forge Capital. Is that the ugly?
I think it is the ugly. People forget that, again, we've mentioned this. Private companies as an asset class, do they make more than public companies? You could quote people like Larry Swedrow that say, yeah, they kind of do. I'm going to look at it and say, but look at all you're giving up. Liquidity, higher cost, and the fact that some go bust. You don't hear about them as much, but as asset class, they're exciting.
Wait a minute. Didn't we just talk about how small cap value stocks have over the long run outperformed large cap growth? The reason is, what is the reason they have?
They're riskier.
They're riskier. So private equity has the potential and darn well better on average, post better returns than the total market or small cap value even, because they are riskier.
Yeah, that's the good, the bad, and the ugly. And so, yeah, Schwab, we love you, but get your house in order. But I guess it's too late now. The cat's out of the bag.
They're not going to.
The money's to be made.
They're not going to. That's why it remains and always will be the Wild West, because it is up. There is no sheriff who's going to ride into town and clean up the desperados out there that are taking your bottom dollar.
Especially when the numbers of people doing that get smaller, and even those people, I guess they don't even go to work anymore because they weren't getting paid for a long time. So
well, and in many cases, the regulated or the regulators become the regulated. So there's very little incentive to regulate too much because you could be giving up a lucrative future position with a major firm. There's just too much self-dealing, and that's. I hate to say that. I hate to say this because I sound cynical. That's us.
Yeah,
That's just us.
We've seen the enemy, and he is us.
We is us.
Yeah, sorry about that. All right.
Question time?
Lots of questions, yes.
These all came in from talkingrealmoney.com on the contact form from those of you who insist that you can't use your voice to ask questions.
Which is, I guess, I'm going to try it because...
Using your voice?
Well, no, I mean recording one on for your program. I don't want
you on there. No.
Oh, I know, but you don't have to use it. I
use you all the time.
I know.
In many ways.
And abuse. John writes us from Normandy Park. Very simple. One sentence. Favorite type of question. What are your thoughts on stablecoin and other attempts to legitimize cryptocurrency? Don.
What's the point?
Legitimize cryptocurrency.
What is the point? I don't understand the point. I know these people, my crypto haters, tell me that I'm just stupid. I don't. One thing I've never been accused of is being stupid.
No.
I mean, I've been accused of it, but I'm not. I don't understand what solution, what problem they're solving for. What solution are they providing that is so important? The arguments to me are spurious, and that's my thinking, is that I don't buy them. Maybe it's not that I don't understand them. I just don't buy them. I don't think they really hold water, and I find it fascinating that those who scream the loudest about anyone who claims that cryptos don't make a lot of sense is generally somebody who owns a lot of crypto.
And you're trying to unload it to the other, what do they call it? Greater fool? Whatever.
It's so funny because honestly, I don't think that I've ever heard from a crypto proponent who didn't have a vested interest in making money off of crypto.
So back to the question then.
I don't have a vested interest in making money off the stock market. I can't manipulate the stock market.
No.
But you guys think you can manipulate the crypto market, and I honestly believe you very effectively have done so.
Oh, no question. That's why the price has run up, because there's nothing there other than what the next person says it's worth.
Then hype.
Yeah. So, okay, so the question then, the answer then becomes, our thoughts are, we don't have any thoughts.
No, I have thoughts. Why?
Okay. Why do we
bother? What's the point? Why are we wasting our time on this stuff?
All right, then let's move on.
The dollar may be weaker than it was, but this is normal. The currencies adjust to each other depending on the economic strength of those countries.
Yeah. Good answer. From Portland, Oregon, Harsha writes us, during retirement, I'd like to use a 5% flexible withdrawal strategy. Now, that refers to taking out 5% of your portfolio value on an annual basis, correct?
Right. Yeah. Correct. My perfect way of doing that would be, just to make it disciplined, is every year at the beginning of the year, or just before the end of the year. Actually, it's better at the beginning of the year because then you can delay the taxes. Beginning of the year, you look at your portfolio value and you go, I am moving 5% of that value into a money market mutual fund or a high yield savings account, and that is my next year's budget.
Okay. And
plus Social Security or whatever other.
I reran my numbers, and I'm going to just keep working. So I'm not going to be taking money out of the portfolio. I'm going to die with my boots on. That's what one colleague said about me recently. So.
Okay, that's only because, one, we kind of enjoy what we're doing.
That's true.
Most of the time.
Yes.
And two, both of us would be bored to tears if we did any. And you can't just, your goal, the dream was always to referee, not with that knee.
No. Well, I'm going to learn more about that soon. All right. There's the question. My current asset allocation is 40% U.S. large cap, 20% U.S. small cap, 20% international, and 20% U.S. Treasury bond. So that's an 80% stock, 20% bond portfolio. I'd like to take out 5% of the portfolio on January 1st every year and move into my bank account, as you just mentioned, Don.
Perfect.
2 questions. Do I withdraw from all 4 asset allocations or only the ones that have appreciated more or only from the bond position?
No, here's what you do. It's from total returns, but there are steps involved. Because we believe that also the one thing you should be doing at least every year is rebalancing your portfolio.
Oh, that's right.
So let's say that next year your international growth now has gone from, what was it, 20%?
20%.
To 25% or 23%.
Which it likely will this year because it's been a great year. Yeah.
So you're going to be moving money now from that. You're going to be selling some of that international growth. The first thing you do is take that 5% out of that money from the sale of those securities that's going to go into the areas where you have less than your original percentage. That'll be part of that. Then the rest of it gets moved. That's the way to do it. If you don't have enough from asset reallocation, then you take your dividends. You go ahead and make the dividends cash payable. That's another way to do it. You just make them paid out into your cash account. And then, only then, would you, after you've done all your rebalancing, then I would take money out of the taxable bond portfolio. Next.
Yeah, it's a total return strategy.
It's a total return
because
strategy.
The question
so
then
you
continued.
pretty much take it equally across the board is what I'm saying.
After withdrawal, do I need to immediately rebalance my asset allocation? Well, but there are years where bonds make money and stocks do not.
Right. So as part of that reallocation, that rebalance, correct, you're going to sell some of the bonds and you're going to be buying stocks. But first, you're going to be paying yourself on $1 million portfolio. First, you're going to pay yourself your $50,000. Then, if there's anything left, you're going to use it to reallocate.
Yeah. So, yes, total return, pull out the 5, and enjoy yourself.
Exactly. That's what if I do retire, that's what I plan to do.
Can I make a joke about Portland there? No, I guess not. So,
how does it relate?
Just because we're in Seattle and they're in Portland. I just like
they're the writers in Portland.
Yeah. But I'm not going to do it.
Why would you do that? I don't
know.
understand.
That just came across my mind. But
is this the Portland-Seattle rivalry thing in soccer or something?
Yeah, something like that. Yeah, but I'm going to let it go now because both of our seasons are over anyway, prematurely. Dave writes us from Cincinnati, Ohio. Hi, Don and Tom. I've read you can convert certain Vanguard mutual funds to their corresponding exchange-traded funds tax-free.
Yes.
I'm specifically looking at converting the 500 index fund, VFIAX, to VOO, and the total stock market VTSAX, VTSAX, to VTI. Both ETFs have
because VTSAX is global, isn't it?
I'd have to go look that up.
But
while you're doing that, I'll continue with the question. Both ETFs have an expense ratio that is 0.01 less than the mutual funds. Are there any gotchas involved to make these conversions? I have about $1 million total in unrealized capital gains and don't want to be hit with a huge tax bill if this conversion is not truly tax-free. The 0.01 annual expense savings would be about $140. There's some small spreads for the ETFs. Not sure this should be factored in the decision. Is there any reason not to go ahead and do these conversions? Thanks, and I really love the show.
Well, okay, a couple things. One, these are obviously in a taxable account, or it wouldn't matter.
Yeah.
So you are getting, or you have the potential to get from VFIAX and VTSAX, which, by the way, is a total stock market index.
That's what he said, total stock market.
No, but he said he was going to move it to VTI.
Which is
just U.S.
Correct. Okay, good point.
He should move it to VT,
but here's
which
the thing.
is global.
Just to go back. The process. So the process, you have to actually contact somebody at Vanguard to do it anyway. So they wouldn't move you from Sachs to VTI anyway.
That's correct.
They would tell you got to move to this fund. They do it for you. They handle it, so there's no mess up in terms of the taxes. When we had it happen en masse once recently with dimensional funds, they did it on their own overnight. We just woke up the next day and they were in ETFs. So, but yes, this will become
just
more.
A bookkeeping entry.
Exactly. It's a share class, I guess it would be a share class move. So, but you're going to contact Vanguard. They're going to handle most of this for you, so you don't have to worry about it. But it's a good question.
There are two advantages. Okay, you don't ever get rid of the long-term gain when you sell. That is always going to apply.
Convert
because your cost basis is going to be whatever it was when you got into the VTSAX. But there are two advantages. One, you're going to pay that lower expense ratio that you mentioned.
That's right.
The other is that you're going to reduce the possibility of capital gains distributions that are taxable.
So that you don't forget about that is what you're saying. It's a huge
I'm just saying
advantage.
you can add that into your savings thoughts.
Exactly. Yeah.
So you're going to.
I would go ahead.
It's a good move.
Yeah, I think it is. But contact Vanguard. They will make sure it's all handled properly. All right, we're squeezing another one here from Dennis in Orting, Washington. My wife is 59, 22 years younger than me, with a military retired 06 pension and will receive survivor benefits when I pass. I have $640,000 in Roth IRA, $127,000 in traditional TSP, thrift savings plan. That is pre-tax. She has $430K in Roth IRA and $900K in traditional TSP.
Wow.
So, Dennis, stay married would be my suggestion.
Wow, Dennis, she did a lot better than you.
Yeah, apparently.
If this is a competition, she won.
Yeah. Well, that does happen. Should she convert her TSP to Roth TSP over 10 or 15 years to reduce the tax burden when I pass? So she's 59. Mm-hmm. But what he doesn't talk about here that would be important to me is what is your current income?
Yeah, I was just going to say, because it really has a lot more to do with what your current tax situation is and your future tax situation is likely to be. Those are the big determinants.
And what your tax rate would be today versus waiting a few years until you're all retired. Yeah. Then your tax rate would be less. Then you could do the conversion. Yeah, and if she's 59, let's see, that means she doesn't have to start taking anything out till age 75. So until
Dennis is dead.
I didn't want to go there because,
Yeah, no. I'm sorry, but Dennis knows
that kind of thing. Yeah, probably.
Just like you know that.
I just try not to think about it. She probably thinks about it a lot, but I try not to think about it. Anyway,
it's depressing for you to think about, but we do need to raise the issue.
It's so. But it's
the right amount of bullying that's important.
It's not too much, not too little. So the thing is, Dennis, yes, you should look at your current tax rate versus what your tax rate would be. Although we don't know the future, I would only base it on what it is today.
Guess.
It's a guess. And then should you convert? Then maybe. Yeah. I mean, and that's a lot of money in the TSP.
Let me add another qualifier, though. Kind of an important qualifier. You should convert only if you can afford to pay the taxes due out of money that is not in the tax-advantaged portfolios.
Thank you. Which is a big people. I withheld 20%. Well, you just did that incorrectly. So that's a very good point, Don. You want to make sure you have the cash to pay the taxes. Exactly. And keep those questions coming because we love them. TalkingRealMoney.com, click on Contact Us. Or conversely, if you have more complexity than just a single question like that, and you want to talk to somebody about it, including myself, you go to TalkingRealMoney.com, click on Meet an Advisor, and we'll respond.
And then you can meet with an advisor, and it won't cost you anything.
Yes. Exactly.
And I promise you, cross my heart, hope to die, pinky swear, that you will not be pressured to become a client. Promise. We just don't do that. Why? We're doing fine. Anyway, thanks for being here, there, listening, wherever there is. You know where you are. And thanks for making us one of the most popular investing podcasts in America, in the world, actually.
Well, and long running. You had some quote recently.
And long running.
How many we've done now and what that means.
We are in rarefied air as we are approaching 2,000 episodes. Only a handful of podcasts have ever gotten over 1,500 episodes, and even fewer have made it to 2,000 episodes. And we're going to hit that.
When are we going to hit that?
We're going to hit that in 26.
So we got to keep going then.
Well, yeah, we got a 2,000 podcast goal.
Okay. Good deal.
Because what are we at? Let me just go look. Hold on. Because I don't think Apple actually.
We're close to 1,800, right?
No, I think we're over.
Oh, we're over 1,800. None of this includes, by the way, previous iterations. This is all.
No. This is just talking real money. And actually, there are some shows missing.
What?
That in a transfer from one web host to another got lost in the shuffle. Oh, no, I take that back. We are at 1,768. So we just passed 1,750, heading for 2,000.
In 2026, you would expect that we do 200.
We do, how many do
five
we
a week.
do? 5
No,
a
that's
week.
only 40 weeks. We do 5 a week, 250.
52
basically.
weeks, so 250.
Yeah,
so we, at the end, about 12 months from now,
wow,
we'll hit 2,000.
I'm going to take care of myself so I can get all the way through there. So
yeah, and then you can die, and your wife will be happy.
Don't say that. It's a good thing she doesn't listen to this. Let's just put it that way.
No, actually, she would be like going, yeah, that's true.
Probably would.
Don's right. It's the truth.
Sundays are so much better
truth.
now than they were for a long time.
I don't have to watch all those damn soccer games all the time.
Exactly. Yeah.
Hey, thanks for being there, and please tell a friend or two about what we do, because we want everybody out there not to be managing money, but we want them to be talking real money.
The opinions and views expressed on this podcast were current on the date recorded.
Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appellate Wealth. The views and strategies described may not be suitable for everyone.
This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction.
Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appellate Wealth, a fee-only registered investment advisor.
Please see Appellate Wealth's ADV Part 2A on our website for information regarding Appellate's fees and services.
Appellate Capital, LLC, DBA Appellate Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appellate does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.